You're watching Derek, the home of financial planning. Now, time for a commercial break.
Du vin, du pain, 2%. Pour homme, pour femme, pour X%.
You're watching Derek, the home of financial planning.
We need to talk about yield curves. Now, the first thing I need to say is what is a yield curve and why is it important to you? Ultimately, what we're talking about here are loans to governments. So why would you loan your money to the government? So if you loan your money to the British government, it's the only government in the world that's never defaulted on a debt. So it will borrow money from companies, it will borrow money from individuals, it will borrow money from other governments around the world to fund projects in the UK, infrastructure, healthcare, you name it, building schools, whatever. And the British government will always give you your money back. The government will take loans or issue notes for those. They're called bonds, and a bond is simply an agreement or a solemn covenant. And it will take loans for anything from a month or two up to 20, 30, 40, 50 years. The longer you tie your money up in one of those loans, the greater is the chance that the markets could innovate a new whiz-bang solution that meant you could be missing out on a much better return. So the government has to compensate you with a higher rate of interest. So what you see is the longer you take a government bond or a loan with the government, the longer you loan your money to them, you get a curve, a yield curve, an interest rate curve. And the longer the loan, then the higher the yield or the interest rate you get from your loan to the government. So that's a yield curve. So what's an inverted yield curve? An inverted yield curve is when the returns for a short-term loan to a government give you a greater return than for a longer-term loan. And when can that happen? Well, that happens when investors get a bit panicky. So if they think that the economy might start going backwards or returns from company shares might go backwards, money will come out of stock markets and it'll be looking for somewhere safe. And it will dash into very short-term loans to the government. So they're super duper safe, but you haven't got to hang on to them for very long. So if the market starts to improve, you can come out and go back into stocks and shares. And what then happens is anyone holding those short-term bonds, they're in huge demand and there's only a limited supply. There's all this money coming out of stock markets and there's not enough of them to go around, and so you can charge a lot more if you want to sell them. And so the price for them, or the money you will get for a short-term bond, the yield goes up. And temporarily, it becomes much, much higher than a longer-term loan to the government. So the yield curve flips the other way. It's very transient, doesn't last for long, and then it goes back the other way. The reason everyone gets very excited about it is because when that happens, it's often a presage for economic instability or a recession. Now, it happened a couple of weeks ago. Largely happened around the slowing of the economy, particularly which isn't being helped by Donald Trump and his trade war with China, isn't helping anyone. Happened very briefly and then it reverted back to normal. But set against a backdrop of slowing economic growth and the potential increased risk of recession, everyone's becoming just a little bit skittish about it. So what does that mean for investors? Well, if it means you're just holding stocks and shares, that's probably not good. But we operate balanced portfolios that have a range of assets diversified globally, which includes short-term bonds and loans to the British government. So when this sort of thing happens and you get an inverted yield curve or money rushing out of stock markets looking for a safe haven, we benefit from that because our holdings in short-term bonds go up to compensate for the drop in stock markets. So to give you a practical example of how that worked, if you looked at the FTSE 100 over the last month, you've seen that it dropped from a high by about 10% at one point. And if you'd just been holding stocks and shares, that's probably what you would have experienced. Our portfolio is, on the other hand, a balanced portfolio which holds short-term bonds, so they go up in value as stock markets come down. the balanced portfolio fell by about 1.07%. So we took about 90% of the pain out of that particular wobble in stock markets. So by having a diversified portfolio, you can kind of benefit from these market movements and actually smooth the ride out a little bit. Now, before you say it, no one is saying that the portfolios will always do this. While it's not a bad indicator of the future, past performance is no guarantee of the future. Before the FCA and anyone else jumps on me and starts saying that. So I can't promise you that will always happen, but that's what happened on this occasion, and that's why you have a diversified portfolio before you start ringing in and shouting at me. Anyway, so that's yield curves, that's why they're important, and that's how we use them. And there'll be more on this next time.
You're watching Derek, the home of financial planning.
Hello, and welcome to Clever Clogs. Our next contestant is Stephen Evans. Stephen, your specialist subject is Stephen Evans. You have 1 minute of questions on Stephen Evans, starting now. Who is the managing director of Evans Hart Independent Financial Advisors?
Me.
Correct. Age 3, who filled the petrol tank of their father's car with the contents of the sandpit, rendering it unserviceable for 6 months?
Me.
Correct. After joining the Scouting movement in the Lake District in 1966, who won a place at the International Jamboree in Idaho, United States in 1969?
Me again.
Correct. Who watched the moon landing while working as a barman at the Old Dungeon Gill in the Lake District in 1969?
That's me.
Correct. In 1973, who gained a degree in economics from Nottingham University?
Me.
Correct. In 1975, who, having completed accountancy exams, who was appointed as a cost accountant in a pork pie factory?
Me.
Correct. In 1978, who climbed Mont Blanc?
Is me the answer to every question?
I'm sorry, can you rephrase the answer?
Me.
Correct. Between 1975 and 1984, who sailed around the Hebrides, Channel Islands, Mull and Greek Islands?
Me.
Correct. In 1987, who became an appointed representative for Hill Samuel Assurance, subsequently establishing Westminco Independent Financial Advisors in 1988?
That would be me.
Correct. In 1993, who met Imran Khan and Benazir Bhutto at a family wedding in Pakistan?
Me again.
Correct. Miles Hart, Independent Financial Advisor, invited who to merge companies with his in 1997, subsequently buying out the whole company in 1999, becoming Evans Hart?
And again, me.
Who likes to lead off karaoke at a party with a rendition of Wild Thing?
That's definitely me.
Correct. Between 2007 and 2018, who oversaw acquisitions of financial advice firms based in Enfield, Folkestone and the City of London, bringing the total funds under management of the Evans Hart Group to over £400 million?
Me.
Correct. Thank you, Stephen. In that round, you scored 13 correct answers with no passes.
Thank you.
You're watching Derek, the home of financial planning.
I'm Stephen Evans, the Managing Director of the Evans Hart Group, including our colleagues from Higgs Boson. And we're holding a recital and lunch for all of our clients so they can get to know each other and hear Junko, a renowned Japanese pianist, who's going to provide a recital for us. Many of our clients appreciate music and arts, and we want to provide this to our clients, allow them to mix and make new friends, and to bring everyone together to enjoy the arts in the community. We always remember that we're human beings first and financial advisors second. And what we're looking to do is to promote the arts for the benefit of members and clients, alongside the work we do for charities as well. Some of the musical charities, but a range of charities, and to put something back into the community.
You're watching Derek, the home of financial planning.